Greetings, ladies and gentlemen. My team and I are very honored to speak at today's session. In this first segment, I will share with you some principles of portfolio construction and how adding private market assets can help you build a better portfolio. When you are constructing your investment portfolio, what are some of the most important considerations you have in your mind? While different investors construct their portfolios differently depending on their investment objectives and time horizon, there are certain portfolio construction principles that every savvy investor should take into consideration. In this video, I will introduce these principles and explain the role that private market assets can play in your investment portfolio. Before we dive into the role of private market assets in an investment portfolio, let me first take a step back and introduce some portfolio construction concepts. Some of you may already be familiar with these, but oftentimes the fundamentals are the most important and we should remind ourselves of them. When constructing a portfolio, a savvy investor should always strive for two outcomes in order to build a better portfolio: better risk-adjusted returns over the long term and robustness. Now, better risk-adjusted returns over the long term. Firstly, I'm sure that we all can agree that we need to take some investment risk in order to generate investment returns. The challenge is always to generate the maximum amount of return for a given amount of risk. And here, risk can be broadly defined and can include portfolio volatility, drawdown, or other measures. This risk threshold differs from investor to investor, but for any given risk threshold, there will be opportunities to increase the expected return of a portfolio for a given amount of risk taken. This is where the idea of expanding the investment universe comes in. According to portfolio theory, if an investor expands the number of investment instruments of different risk-return characteristics he or she has access to, the number of different portfolios he or she can create will likewise increase. In turn, some of these portfolios will have superior risk-return characteristics than the best portfolio the investor could build previously. And in technical terms, this refers to an expansion of the efficient frontier for the investor. By increasing access to different instruments, especially those whose returns are lowly correlated or uncorrelated to existing investment instruments, the investor will be able to build better portfolios that have a higher expected return for the same amount of risk. What this means in plain English is, by expanding your investment universe, you will be able to earn more money over the long term with the same amount of risk. While it is always nice to generate higher expected returns without taking additional risk, the related question is what the portfolio will do when markets turn bad. This is where the concept of portfolio robustness comes in. In short, a robust portfolio is one that performs reasonably well across a broad range of plausible market scenarios. It may not be the best performing portfolio in any particular scenario, but neither will it perform terribly in any given scenario. This is important because markets are notoriously unpredictable, and we cannot pretend to know what scenario will play out. Hence, a savvy investor should construct a portfolio that's sufficiently robust. As it turns out, the addition of investment assets that are lowly correlated or uncorrelated to existing assets not only results in higher risk-adjusted returns, but also enhances portfolio robustness. This chart and the table show the drawdown performance and other metrics of the equity market, a public market 60/40 portfolio, and a globally diversified portfolio that contains other investment assets that are lowly correlated to public market instruments like listed stocks and bonds. You can see that in periods of crisis, the diversified portfolio not only performs less badly, but also rebounds more quickly than the others. This results in higher compounded returns to the investor. At this point, you may be thinking about publicly traded bonds as a diversifier to your portfolio. While bonds are the traditional diversifying asset class for equity-centric portfolios for most investors, it suffers from two drawbacks. It may not be as diversifying as you think. If we look at this chart, which shows the correlation of publicly traded stocks and bonds over time, you can see that the correlation between the two shifts quite dramatically, specifically in the periods of 2017 to 2019, where the correlation turns positive due to the uncertainty and divergence around central bank policies globally. The second drawback relates to the effects of bond allocation on the overall return of the portfolio. as we can see from this slide, the long-term returns of listed bonds are low. Indeed, bond returns have declined over time and are likely to stay subdued over the medium term. This represents a return drag on the overall portfolio. And this is where private markets can play a role in your portfolio. By private markets, I'm referring to the various asset classes that are not listed on major exchanges like New York Stock Exchange, Hong Kong Exchange, SGX, and so on. These would include private equity, private debt, unlisted funds, hedge funds, PE funds, VC funds, global macro funds, private credit funds, and so on, and unlisted structured products. As we can see from this slide, many private market asset classes are not only lowly correlated to public market assets like listed stocks and bonds, they also have very good historical and expected returns. By adding or increasing the allocation to private market assets in your portfolio, you will be able to reap the benefits of better diversification, leading to higher risk-adjusted expected returns and enhanced portfolio robustness. In short, you can build a better portfolio with private market investments. This is not just theory. The biggest, most sophisticated investors in the world have a significant allocation to private market investments in their portfolio. Take a guess as to whose asset allocation this is. One of the common reactions to this discussion on allocating more to private markets is this: there's just no way to access such investments. These investments into private markets have traditionally been limited to institutional investors, pension funds, sovereign wealth funds, large asset managers, and ultra-high net worth individuals. Even for individuals with private bank accounts, not all private banks have a well-stocked shelf of private market products that investors can invest in. This is a consequence of how market infrastructure supporting private market investments has evolved over the years. But in the next video, we shall see how technology is bringing about new ways of accessing private market investments in smaller bite sizes. This then opens up the world of private markets to every investor and allows investors with portfolios of any size to build a better portfolio, just like GIC and other sophisticated investors.